Hello everyone, this is Akshara Menon from PMS Bazaar. Along with me, we have Mr. Surjitt Singh Arora, the Principal Officer and Portfolio Manager at PGIM India PMS, to capture the last quarter happenings, also to share some more about his strategies. PGIM is a global investment management business of Prudential USA, the 11th largest asset management manager in the world. PGIM India Asset Management manages net assets over $2.8 billion approximately. Without any delay, let's jump on to the quarterly update. So before I could brief upon, let me ask you the first question, sir. Can you just brief about PGIM India PMS and its principles?
Yeah, good morning. Before I go to your question, I will just start with a quote. It is impossible to produce superior performance unless you do something different from the others. So before moving to your question, if I give you a brief overview of PGIM India PMS. So we started PGIM India PMS in July 2013. So we have now completed a decade here. And if you look at what we stand for, we have an experienced research team. We have equity strategies to be offered to our clients with a GARP philosophy, which is growth at reasonable price. And normally when we get money from our clients, we deploy it over 4 to 6 weeks. So if I look at our history, we have completed a decade, and our first strategy, which was launched in July 2013, it was PGIM India Core Equity Portfolio. Now, if I look at our process which we follow here, it's basically filtration criteria is the first part where we look at filtering the stocks for our investment universe. So just to give you an example, normally if you look at our portfolios, they are mainly debt-free companies, or net debt to equity will be marginally there. Again, if you look at the quality of the portfolio per se, apart from quality, people say we invest in a lot of good quality companies. Let me define a good quality company for you, right? When we say good quality company, what we mean is it has to have a scale in terms of revenue. It would have gone through a downturn cycle and has emerged as a very strong company, has consistency in terms of cash flow, and it has a decent ROCE profile, which is return on capital employed over the last 10 years.
Okay, thank you, sir. When you consider growth at reasonable, so what are the factors considered for the price to be reasonable while picking a stock in your portfolio?
Absolutely. So if you look at our philosophy, that is growth at reasonable price, which we call it GARP. Now, as you rightly alluded to, when we say reasonable, the thing is, I will just give you a simple example. One of the ratios which we use for identifying GARP as a strategy or reasonable valuation as a strategy is basically PEG ratio. For the benefit of the audience, let me simplify this further. A PE ratio is a price to earning multiple for a particular company, and growth is defined as the next 3 years CAGR in terms of earnings growth for the company. So for example, let's say a company is trading at 40 times 1 year forward PE, and the earnings trajectory, the earnings CAGR over next 3 years is 25%. So the ratio PE divided by the growth is 40 divided by 25, which is 1.6 times. So as a process, as an investment framework, what we do is any stock which is between 1 to 1.5, 1.6 becomes a part of our investment universe. And the moment the stock hits 3 and above that in terms of PEG ratio, we exercise caution in terms of either partially booking profits, or if we believe the valuations have gone through the roof, we don't shy from taking profits off the table. So 1 to 1.5, 1.6 is a good level to look at when you invest in a company. On the other hand, above 3, it's a kind of a red flag for us where we are not comfortable with the valuations. Just to take your point forward, when we say GARP, right, growth at reasonable price, it's a very good strategy which balances the two tenets of investing, which is growth as well as value. So normally when we do equity investing, we do it for growth, right? But equally important is the valuation which one pays for growth. Hence, GARP as a strategy balances both growth as well as value.
Okay. But saying that, what are the guiding principles used to reduce the risk in your portfolio, sir?
Yes, so absolutely. In investment, risk mitigation becomes a very important part. So if you look at the process followed at PGIM India PMS, normally we don't go beyond 10% in terms of individual stock weightage, and in terms of sectoral exposure, we don't go beyond 30%. So again, just for the benefit of the listeners, I will give you a very simple anecdotal evidence. If you look at our top holdings in our portfolios, right, when they did very well and the individual weight of a particular stock, let's say stock A, went beyond 10%, there we were not comfortable with valuations. Again, a GARP philosophy of, more than 2.53 times PEG ratio. That time, from a 12-13% kind of allocation, as an example, we came down to 5%. So this is a risk mitigation approach where, as I alluded to earlier, we don't go beyond 10% in the single stock and we don't go beyond 30% in the single sector. So we are very cognizant of the fact that we don't want to overstretch ourselves in terms of exposure to a particular stock or to a particular sector.
Okay. With saying that, so let us jump on to the portfolios. Can you elaborate on your PGIM India Core Equity Portfolio investment approach?
Yes. So as I alluded to in my opening remarks, this is our flagship portfolio, which is PGIM India Core Equity Portfolio. We have recently completed a decade here. And just to give you some numbers, our 10-year performance is 15.95% return, vis-a-vis 13.98% return for Nifty 50 TRI return, right? So as you rightly alluded to, if you look at the qualitative parameters or the framework in terms of developing the investment universe for core equity, these are 4 parameters. One is a scalability in terms of revenue. Second, we look at 15 years of existence for the company. So the minimum age of the company has to be 15 years plus. Again, in terms of cash flow, we look at 7 out of 10 years. The company should be able to generate a positive free cash flow. And then higher ROC. Again, just to give you an example, every sector is different. A sector might have, a different sector might have a 10 to 15% ROC. Maybe a FMCG sector might have a 50-60% ROC. So depending on sector to sector, industry to industry, we look at a better or higher ROC in that particular sector. And hence, these all 4 parameters become a part of our investment universe. So in India, we have almost 6,000 stocks. If we have these 4-5 parameters into our framework, then we boil down to 180 to 190 stocks. And from that 180 to 190 stocks, we buy around 20 to 22 stocks in our portfolio.
Saying that, what is the highest percentage of cash held by this portfolio? Has it been during this time where have been like the interest risk, interest rate high times?
So frankly, again, this is my experience, which I'm sharing, is that normally cash is a residual call, right? So investment in PMS is pure bottom up. End of the day, we don't take cash calls per se. It's about the opportunities available at a different given point of time. And hence, we are not fixated to a particular number in terms of cash exposure in our portfolios. Having said that, if you look at currently our portfolios, on average, we carry 3 to 5% kind of cash position in our core equity portfolio at this juncture.
Okay. So if you could elaborate on the attributes that you look for stock construction of your PGIM core equity portfolio.
Yes. So the first parameter which goes in our constructing of our portfolio is ROC. So if you look at the attributes of our portfolio of core equity, the ROC as of 30th June for the overall portfolio level is 23.6%. If you look at the average age of companies, which I alluded to, it has to be minimum 15 years. The average age of companies in PGIM India core equity portfolio is 48 years. Again, if you look at from a risk profile, our beta of the portfolio is 0.88. And the good part is Sharpe ratio, which is return per unit of risk, is 2.1. So with lower risk, the returns are higher. And if you look at overall, again, the net debt to equity is less than 1 for a core equity portfolio.
Okay. What are the sectors does this PGIM India core equity portfolio considering to investing in?
Yeah. So if you look at our overweight positions or the sectors where we are quite positive on, the first sector is industrials. And industrials is a very broad framework, right? So if I break it up, industrials in our portfolio includes bearing companies, capital good companies, defense companies, right? So industrials is one sector where we are quite positive on. Just to give you some highlights on industrial sector, if you remember in a recent announcement by our government of India, they have allocated more than $32 billion for PLI scheme, which is Production Linked Incentive Scheme, right? So basically what they are trying to arrive at is our import substitution has to be there, and Make in India as an approach has to continue. So from that angle, if you look at Make in India or import substitution, government wants to encourage domestic manufacturing. So from that angle, a PLI scheme, which incentivizes domestic manufacturers to put more and more capex in the domestic units, helps them in terms of over next 4 to 5 years getting incentives from the government. So it is on the incremental revenue which the company generates out of the capex which they have done in the domestic economy. So Make in India plus import substitution will help in terms of getting that incentive on the production linked incentive scheme. Hence, from a structural point of view, from a long-term point of view, I think industrials as a sector could do well.
Okay. So when you talk about industries and all, but you are very bullish at auto sector. You have always been bullish at auto sector. So what is your current take now for auto sector now?
Yes, as you rightly said, we have been holding on to autos for some time now. I will take you back in history, let's say 1 year prior. That time, auto industry was going through a tough time, given that COVID had struck everyone. Plus, at the same time, the raw material index had gone up, and hence the ability of the auto companies to pass on the cost to the end consumer was limited. Their margins were coming under pressure, and at the same time, because of COVID, people were not buying cars. Fast forward to 2023. People are now looking at, adding a car to their overall household, assets, simply because after COVID, everyone wants their own personal transportation, right? So the car demand is going up. Second, the raw material, the inflation which was there in raw material last year, now it has corrected to a certain extent. So if you analyze the historical last 2 quarters numbers of auto companies, majority of auto companies have been able to report better margins because the raw material index has come down. Plus, at the same time, with aspirations and with the new kind of products getting launched in the market, there is a lot of excitement about auto sector per se. So from a last year when you had a lot of headwinds, today you have a lot of tailwinds for the auto sector. And despite the run-up, valuations in our GARP framework look to be reasonable at this point of time.
Okay, with that, they're coming to the main part of this session. So what were the returns delivered for this portfolio in the last quarter?
Yeah, so if you look at
2023.
Yeah, so if you look at June quarter, the returns ending June 30th, we have outperformed Nifty 50 by almost 718 basis points. So our return has been around 18.5% versus Nifty, which is around 11 odd, right? So 718 basis points outperformance has basically come from 3 angles. One, we were overweight on industrials, which we just alluded to. Second, we continue to be overweight on autos. And third sector where we were overweight was chemicals. So if you do the attribution analysis, these 3 sectors helped us in terms of outperforming. On the other side, we were underweight on IT. So IT, if you look at from April to June quarter, did not do that well. And because we were underweight IT, we did a decent job in terms of outperforming the index from a quarterly perspective.
Okay. So let's move to the next strategy, is PGIM India Phoenix Portfolio. So if you could encapsulate for us about that portfolio.
Yeah. So if you look at PGIM India Phoenix Portfolio, it's predominantly a small and mid-cap oriented approach. So if I just give you some numbers, as of 30th June, 56% of the allocation in Phoenix portfolio was towards small cap, and around 20% was mid cap, and remaining was large cap, right? So from that angle, it's predominantly a small and mid cap oriented approach. Now there are 2 pillars which go into, again, constructing the portfolio for the Phoenix part of the leg of the portfolio. One is the structural companies. So we all know India is a growing market. India is a developing economy. A lot of companies are unorganized, or a lot of companies are unlisted currently. So what happens is, when the economy grows and the development happens, a lot of shift happens from unorganized to organized. So the organized companies or the listed companies normally are able to gain market share on a slightly longer term, right? Plus the spending capability of the customers goes up, and hence the demand for their products go up. So from a structural point of view, given the income levels, given the developing economy, and given the growth, we believe sectors such as again real estate, autos, industrials could do very well from a structural point of view in India. So one part of Phoenix portfolio is structural companies. The other part is cyclical companies, right? So we have sectors like commodities, we have sectors like textile, we have sectors like cement or paper, which are cyclical in nature. So what happens is these companies are good, their balance sheets are strong, they are either the leaders or the second best in their sector. But because the overall cycle is negative or because the macros are negative, they are currently not performing. But given their balance sheet strength, given their cash flow strength, we believe over a period of time, the cycle will turn. And once the cycle turns, there could be a possibility of earnings revival for these companies. So Phoenix is a perfect blend between structural stories and cyclical companies. So if you look at today also, more than 60% is structural, around 30-35% of the portfolio is towards cyclical companies.
Okay, with saying that, what would you say the unique features in small mid-cap oriented approach like PGIM India Phoenix strategy that makes it stand out for the investors?
So if you look at PGIM India Phoenix portfolio, there are three parameters which stand out for us. One is if you look at from an overlap point of view, our overlap is lower compared to what the benchmark is, right? So we have a lower overlap with the benchmark. Second, if you look at again, our exposure to small caps is higher. Third, being a PMS, it's a concentrated portfolio. So normally we have a 22 stock portfolio in Phoenix portfolio per se. So given that it is a concentrated portfolio and given that the top 10 holdings account for 55-60%, it gives you that kind of conviction calls in the portfolio. So conviction calls, concentrated portfolio, low overlap with the benchmark. And as I told you, if you look at the parameters here, compared to what I explained in core equity, in Phoenix portfolio, the parameters are ROE, which is return on equity. Again, here we are looking at 6 out of 10 years, the company should be able to generate positive operating cash flow. And again, the net debt to equity is relatively lower. If I just give you the attributes for this product, again, the ROE of this product, PGIM India Phoenix portfolio, the ROE is around 14.5%. Again, the beta of the portfolio is 0.74 and the Sharpe ratio of the portfolio is 2 times. So again, with not undue risk, the returns are relatively okay for this particular product.
Okay, so let's again, we come to the main part of the session, is that how has this particular portfolio has performed over the last quarter?
Yeah, so if you look at from a June quarter perspective, we have delivered a return of 17% vis-a-vis Nifty, which was around 11.1%. So there is a 600 basis points outperformance here. If I look at the sectors where we were quite positive here, so one was the real estate sector. So we are playing real estate sector through either direct real estate companies or through building material companies. So real estate sector, we were positive. Again, if you look at our Phoenix portfolio, almost 14-15% allocation is to Tata Group companies. So that is one more sector which has helped us in terms of outperforming. And here also we have been underweight on IT per se. So overweight on real estate, Tata Group companies, and underweight on IT helped us in terms of outperforming from a quarterly perspective.
Okay, so one more strategy that PGIM India possesses is that PGIM India Equity Portfolio. So what is the approach for you for this fund?
Correct. So as you rightly alluded to, this is a relatively new fund. So the inception date for this PGIM India Equity Portfolio is 19th Jan 2023. So it has completed hardly 6 months. But the beauty of this product is, again, as I explained on Phoenix part, in India equity portfolio also, there are 2 major structural factors which go into building the portfolio. One, here we are playing operating leverage as a theme, right? So just to explain you operating leverage in a bit detail, is basically a lot of companies entail capex. They have already gone through capex, and now we believe over next maybe 3 to 5 years, their utilization will start improving. The capacity utilization for these companies will start improving because the capex is either done or they are almost at the verge of completion of that capex. So once the capex is done, two things will happen. One, your utilization will start going up. And second, because you have a fixed cost structure in your P&L and balance sheet, because of higher revenues and with fixed cost structure, the possibility or the probability of the swing in profitability could be very high. So normally, operating leverage happens in manufacturing kind of a setup where your utilization starts going up, your fixed cost structure is kind of fixed, and hence whatever revenue growth you see, it percolates down to the bottom line in terms of earnings growth for the company. So again, our ability or our team's ability as a research is to find companies which can double the earnings over 4 to 5 years. It's very easy to say, right? I mean, believe me, it's quite difficult practically. But we as a team, we as a research team, try our best to look at the probability of earnings doubling over 4 to 5 years. And because the theme fits the operating leverage, framework, it becomes a part of our investment universe in the India equity portfolio. So broadly, again, 2/3 of the portfolio will be in operating leverage, and the remaining 1/3 will be in turnaround stories. So when you say turnaround, again, these are good quality companies. They are the leaders or the second best in their respective sector. Cash flows are strong, balance sheets are strong. It's just that they are going through a difficult time. Either it's the cycle is bad, or the overall environment is bad, or the pricing power is not there. But we believe the near-term earnings might be under pressure. But because the near-term earnings are under pressure, the valuations also are correcting. And hence, we believe over next 3 to 5 years, if this turns, the cycle turns, and company is doing the right things in terms of their product, in terms of their balance sheet, it's a matter of time. Once the earnings start turning, people will be cognizant of the fact that earnings are coming back to normal, which might take its own sweet time. But we want to believe that currently, given the correction in the stocks and given where the valuations are, it is good time to accumulate these kind of stocks. And with a 3 to 5 year perspective, when the tide turns, you will see earnings also coming back. And there is an outside possibility where the P multiple or the valuation multiple also could re-rate for these companies. So again, it's a blend of structural, which is your operating leverage, and your turnaround candidate. So India equity is broadly on these two pillars in terms of constructing the portfolio.
Wherein you said that this is a very new strategy to PGIM India compared to others. Do you have any different risk mitigation for this portfolio?
Yes. So here what we do is, because we have turnaround candidates in the portfolio, so we have to be very cognizant of the fact which sector or which industry or which stock we are getting into, right? So what we do is we again look at 6 out of 10 years the company should be able to generate positive operating cash flow, right? So because it's a turnaround candidate or it's a cyclical company, in last 10 years, it might have gone through a lot of volatility. So 6 out of 10 years gives you a lot of confidence that a company business fundamentals are intact, right? So to mitigate the risk, that's one parameter which goes into this. Second, the net debt to equity has to be less than 2. So when we look at these two parameters, cash flow and the net debt to equity on the balance sheet, it gives us kind of probability that, at least we are getting into a quality company. It's a matter of time. We can't time it. We don't know when the turnaround will happen. But because of the balance sheet and the cash flow, it gives us reasonable confidence that whenever it turns, whenever the tide turns, and whenever the turnaround happens, these companies can, give a decent performance in terms of earnings to the investors.
Okay. So we have come to the main part of the session, is that how has this particular PGIM India Equity Portfolio has performed?
So similar to what I said in Phoenix. So coincidentally, even for India Equity Portfolio, as of 30th June, our return is 17.1%, vis-a-vis Nifty 11%. So again, it's more than 600 basis point improvement. Here, compared to Phoenix, here the sectors are slightly different. So here we have been overweight on healthcare. We have been overweight on asset management companies, and we have been underweight on industrials and IT. Because of this, we have been able to outperform the benchmark from a quarterly perspective. Yeah. So with that, we've come to the end of the session, and we have given a very brief explanation about how the previous quarter happened for PGIM India. So thank you, sir. Thank you for enlightening our investors on the previous quarter happenings. Thank you. Thank you so much.